Hi, I'm Jonathan Sadock from Paragon Ventures. This is my illustrious partner, Mark Rose. And we wanted to talk to you a little bit about the merger and acquisition market for healthcare companies in the current marketplace. And Mark, what would you say is the number one question that business owners ask when thinking about selling their business?
Well, the number one question that any business wants to ask is, what is my business worth? And in order for a business owner to know when they want to pursue an exit strategy or how to pursue an exit strategy, they need to assess the current value of their business so they know as a benchmark what it's worth now, and where they need to get it to so that they can achieve their target goal. They may find out that their business is worth their target goal right now, and it might be time for them to sell. Or it may be worth X when their target goal might be 2X. So at that point they know precisely how much they have to grow their business, and then they can put a plan into action to do that.
One of the things that I found very interesting is that sometimes a business owner will call us and they will say that they heard about this transaction in a newspaper or through some industry publication, and they assimilate that transaction to the value of their business. Is that an accurate metrics of determining value?
Well, I mean, no two businesses are alike. Businesses are some can be very similar on the surface, but they have different ownership, different accounting methods, different business models, and just because one company gets a certain price, that doesn't necessarily mean that a similar size company is worth the same. Valuation is 99% of the time a function of earnings. So, the business needs to know what their earnings, truly what their earnings are, and even more specifically what their EBITDA is, which is earnings before interest, taxes, depreciation, and amortization. That is the key factor, earnings factor, that is considered in most mergers and acquisitions.
So then, one of the things that a business owner might need to do is really understand what the EBITDA of their specific business
Correct.
is, and then how it's perceived by the buying public.
Correct.
By the market.
EBITDA is not necessarily an easy number to determine. You've got your income from operations. All businesses have different expense philosophies and salaries and bonuses and owners benefits and perks and so forth. It really requires a professional firm to determine not only the EBITDA but the adjusted EBITDA, so that it can be an apples and apples comparison with other transactions in the sector.
I know that one of the things that we've talked about often was that how a business looks in the eyes of the potential buyer, and that certain buyers will give credit for certain add-backs to the EBITDA number when determining the value of the business.
Right. We call these types of things synergies and economies of scale. And they're more prevalent in strategic buyers, and strategic buyers are buyers that are currently in that same business, most likely on a larger scale, and they're looking to absorb or to add in an acquisition candidate. And typically the strategic buyers have these synergies because they've got a lot of duplication and overlap mostly on a lot of their general administrative expenses, but in some service areas there could even be more. Most buyers, they want to keep the benefit of those synergies, but there are ways to do some negotiation on behalf of a selling company.
Now, a lot of our transactions are with private equity firms, and how would valuation differ when selling to a strategic buyer like you just explained versus a private equity firm?
Well, a private equity firm is typically going to make a platform acquisition. In other words, they're going to buy a company that is going to be the base, the foundation to grow. They do buy add-ons for some of their portfolio companies, but they're typically looking for companies in the $3 to $5 million EBITDA range that can be platforms that they can then grow and then exit in 5 to 7 years at a substantial profit, capital gain.
So then at that point, when the private equity firm acquires the platform company, they in essence become a strategic acquirer as well.
That's correct. That's correct. The key difference is that in a private equity platform acquisition is they're not operators of this business, so they highly value a highly motivated owner that has a strong management team that wants to stay on in the new entity with new ownership, taking maybe 70 or 80% of their equity off the table, cashing out some major chips, but also keeping a substantial form of ownership in the 20 to 30% range moving forward, and working with the private equity firm as partners to grow this company. And then in 5 to 7 years, sometimes as short as 3 years, then sell that company again, and then they can, what they say, take a second bite of the apple. And that second bite sometimes can be as large as the first bite. Typically in these private equity transactions, it's a straight multiple times the EBITDA. There really aren't any synergies because there's no overlap. This is a platform company, so and they need the owner to stay on and keep skin in the game, so that then they can have a second capital gain event in 5 to 7 years. The strategic buyer is really buying the company to absorb it into their existing infrastructure. So, having the owner stay on and isn't as important to them. So they typically can pay a little more for the company, and typically buy 100% of it. So there's different. The strategic acquisition is probably better for owners that want to retire, or maybe want to move on to another opportunity, or maybe just want a low stress. You want to stay on as an employee and just work for the buyer. The private equity firm is more for someone that wants to stay with the business, but may have grown it to the point where they don't have either the expertise or the capital to take it to the next level, and then they can partner with the private equity firm to do that.
It sounds like throughout all of these options and in the discussion of valuation, that the business owners today have many options.
Absolutely. And they really need to engage with a merger and acquisition professional that can help them identify opportunities and ensure that they're considering all of their strategic options, because there are many different options out there.
Well, that's excellent. Well, it was nice to discuss this with you, and thank you for tuning in to Paragon Ventures. Have a great day.